Now, the next session coming up, I'll be bringing Vaughan Hain from Ethinvest. I'll be inviting him up to the stage in a few moments, and he'll be hosting a panel talking about retirement portfolios, what they should look like and why. So Vaughan's right here, and please make him welcome. Thank you.
Hey, thank you all for coming, and welcome to IMAP, and thank you to IMAP for hosting us today on the land of the Gadigal. This session, retirement portfolios, what they should look like and why, aims to address perhaps the most significant issue facing the super industry at the moment. With around $4 trillion in assets, the Australian superannuation system has done an exceptional job of building a retirement savings pool for millions of Australians. We now, however, enter a new phase where a whole generation of workers who have received compulsory super contributions their whole working lives begin to retire. So how can this world-class system, the envy and perhaps model for many nations around the world, be better equipped to meet the needs of Australian retirees? As many advisors in this room would know, ensuring clients have enough financial assets at the start of retirement is only half the battle. The missing, or perhaps underappreciated piece, is giving retirees the confidence that they can get what they want and what they need for what some could be as much as half a century in retirement. My name is Vaughan Hain. I'm a financial advisor and portfolio manager at Ethinvest, and I'm joined today by Oliver G, portfolio manager at Pendal, and Julian Lefcovitch, wealth management product specialist at North. Julian and Oliver will each offer some solutions on this topic, and then we shall have followed by a brief Q&A, so please save any questions to the end. Thank you.
It is great to be here with you all this morning. The topic that we'll be talking about is retirement portfolios, what they should look like and why. But if you don't mind, I'm going to start with the why before we get into the what. I think that will provide some useful context and a bit of a foundation to then think about what it means for advice strategies and for investment products. So I think it's fair to say that retirees are facing the same perennial problems. So this generation of retirees are facing the same perennial problems as generations before them. But I would argue that the context and the environment in which this generation of retirees are in, I would argue that the stakes have never been higher. We see longevity or life expectancies increasing, rising costs of living, potentially moving into a lower interest rate environment, and we're seeing high levels of volatility in the market. And that's creating a degree of complexity that previous generations just haven't had to face into in the same way. What does that mean? Well, in a world of uncertainty, the one thing is highly certain, and that is the need for good quality financial advice. And if you're a financial advisor, it's a great time to be in the industry. You've got 700,000 Australians retiring in the next 5 years. And this is a really wealthy demographic. In fact, these retirees are the wealthiest cohort that have ever lived. And even on the world scale, Australian retirees are incredibly wealthy. So they've got a lot of money to protect. And they need advice. So when we're thinking about building retirement solutions, there are a few things that are front of mind. We're thinking about how we mitigate some of the risks that these retirees are facing into: longevity risk, market risk, sequence risk. We're also thinking about some of the emerging trends and preferences that this cohort are seeking. So when it comes to, I'll just talk about a few of those themes, and then we'll move into the, well, what does that actually mean? Now, longevity risk is something that is top of mind for us. It's top of mind for clients as well. We want to give clients the confidence to spend in retirement. The challenge is that, and I've already mentioned that, this generation, they're living longer than previous generations, 7 years longer compared to retirees, in the 1960s. So their capital has to last longer. And that means that, unfortunately, when we speak to clients about longevity risk, they understand the risk, but they don't understand the so whats. They find it really difficult to put in strategies in place to protect them against this risk. So what do? They typically draw the legislated minimum, and they underspend. There is a real fear of running out of money. It's a really hard thing to do, to predict how long you're going to live, and it's even harder to then put a strategy in place to smooth consumption over time. So I think there's a real need for product designers and advisors to face into this risk. When we think about market risk and sequence risk, a lot of clients understand the former, the market risk. I think they're very much attuned to the media and as they get closer to the retirement, they're kind of checking their balance more frequently. So they understand market risk, but sequencing or sequence risk for us is a bit of the silent assassin. It can have absolutely devastating impacts on a client's portfolio. And I might just give you a bit of an example of what that means, and then we'll talk about how we can address sequence risk. So this shows, sequence risk. If you want to mix up a cocktail of sequence risk at home, you need two key ingredients. You need high levels of market volatility and negative cash flows. Not an issue in accumulation, but can have devastating impacts in drawdown. If you just look at the second chart there, you've got two different clients. I'm going to call them purple and blue. And blue, unfortunately, and they're in drawdown. They're taking 35,000K as an income stream. They've got $500,000 in their account-based pension. Now, unfortunately for blue, they retired during the GFC. So they retire in a bear market, and that takes and their capital balance takes a huge hit. Purple, they retire during a bull market, and you can see that towards the end of their journey, they enter a bear market. So for blue, retires during the GFC, drawing a 35K income. By the time they're 84, they'll have no capital. Whereas for purple, same sequence of returns, but just reversed, they still have about 600K at 84. So sequencing risk can have absolutely devastating impacts at retirement. The other thing that we're starting to see is a growing preference for capital, stable returns and capital protection. And you can see why this is the case, right? Like retirees have lived through the GFC and more recently COVID. They've got a lot of money to protect. Unfortunately, you just can't, as we all know, have your cake and eat it too. So stable returns often means lower levels of risk, which means lower levels of returns. And if you think about an environment of rising costs, that's not necessarily a good combination. So we think that there's a need to consider capital protection as part of your portfolio design strategy to help protect against losses. And there are some interesting products that exist in the market that allow you to have full exposure to growth of your assets, but they also provide a 100% downside protection. Now that obviously protection comes at a cost, so that needs to be considered. But I might just compare just two different scenarios here. A lot of advisors or clients, as they approach retirement, they de-risk to reduce the level of sequencing risk and market risk. So they might be in a growth portfolio. So here's an example of a client. They're 50. They've got a growth. They're invested in a growth fund. This shows you, illustratively the range of returns that this client might expect over the next 10 years. So you can see high upside, but with a level of downside. So quite often, what we'll do is we'll de-risk the client as they approach retirement. We might move them to a moderately defensive portfolio, which reduces the upside potential, but also mitigates any downside risk. An alternate strategy to doing that is to use a level of capital protection, which provides a floor through a hedging program, but in doing that, you can still remain invested in growthier assets, so you do get the upside. And even when you take into account the fee for these products, they can still be quite advantageous. Here's just an example. I've compared the median growth returns of a growth fund over the last 15 years at 8.6%. Let's just say the capital protection will cost around 165 basis points. You get a net return of 6.95% compared to a moderately defensive fund, which has returned 6.2%. So it's worth thinking through. If the need is stable returns, how do you deliver that? Deliver on that, but not completely move away from growthier assets and the returns that come with them. Another great way to manage sequence and market risk is through using an SMA. The ability to outsource investment management and the ability for an investment manager to take advantage of upswings in the market and provide some protection by acting quickly is highly beneficial. And that might be a good segue to pass the baton across to Oliver.
Thanks, Julian. Hey, everyone. Thanks for having me. I'll try to make this quick. I've been in markets for over 15 years, and the one thing I've learned about retirement investing is that it's more than just making money, right? It's about making sure the money lasts over the course of a lifetime. And to do that, we kind of need to solve for the collection of challenges, which kind of bucketed up here in terms of retirement challenges into stability, liquidity, and growth. Now, the focus of this talk for me will largely be on liquidity, because I think it's the most important one of the lot, but also for me, I think liquidity, when I talk about it, stability. When I talk about stability, it comes in two flavors. One is around stability of income, which is making sure people get a steady paycheck. And the second one is stability of returns, which is making sure portfolios are protected against market downturns. In terms of addressing each of these pillars, I'm going to share with you one of the ways we go about pursuing the stability. And again, the first way we are going to think about it is how we generate income, and in particular, how certain middle-of-the-road solutions aren't as compelling as they seem. And the second thing I'm going to share with you is how we leverage off machine learning and AI to navigate some of the trickier parts of the market cycle, specifically around interest rates. So to start, let's talk about income, right? When people talk about stable income, they're thinking about bonds, they're thinking about TDs, but increasingly that's not enough. Increasingly people want high incomes, which means they reach for hybrids, they reach for private credit, and those things are good. They give very, very strong returns, but they also carry risks that not everyone's fully aware of. And in the case of hybrids, I'm a bit embarrassed to admit, but I fell for some of those drawbacks personally. So, in my early 20s, I got involved in a forestry business called Guns. I don't know if you guys remember it, but yeah. I knew it was a bit of a gamble, but I also thought by dipping into the hybrids, I could maybe get something back if things went south, right? But that didn't happen. I lost everything, including $15,000 I borrowed from Mum, so she's very upset with me to this very day. But still, look, the point of making here is that with every one of these high yield investments, there always is an implicit agreement to take on equity risk, right? And if you're prepared to assume that risk, then that's great. And I believe you should be paid for it. But the thing is, with certain hybrids, you're not getting what you deserve. And so the question becomes, can you do better? And I believe we can. I believe there is actually a better way of building out a more efficient income engine. And let me quickly show you what that looks like. So the yellow line here is the CBA Pearls Index. This is basically our proxy for hybrids. The dark blue line is a composite blend of 90% cash and 10% CBA stock. What you notice here right away is that the blended portfolio outperforms the hybrids index over the long run, as well as experiencing shallower drawdowns, lower volatility, and all that like. And specifically, if you look at the GFC in 08, 09, the hybrids index lost 15%, but the alternative strategy fell less than 5%. The same thing happened during COVID. You had a 15% drop there as well, and the blended portfolio was relatively stable. The other little bonus about the dark blue line is that you get extra liquidity, because in times of stress, it's much easier to get rid of 10% of your stock in CBA shares than it is to get rid of 100% of a listed hybrid. So there's a lot of positives there. And when you put it all together, you realize that while hybrids can be a compelling source of high income, it's not the best out there. You can do better, and this is proof that you can generate a more efficient income engine. Now, normally there is a trade-off between risk and reward, but not in this instance. And as a result, we don't put any hybrids within our portfolios. We instead employ a variant of that dark blue line to kind of generate that efficient income engine we're talking about. And if I could just show you what that looks like in practice, here it is. The dark blue line is our flagship retirement product called the Monthly Income Plus Fund. It pretty much incorporates all the principles that I've outlined earlier, as well as having an active management process on top. The yellow line here is the Aussie Banks Preference Shares Index. So it's not just CBA this time, it's all the majors in there. And again, what you notice in like the previous chart, just by being a little bit more mindful about portfolio construction, you can achieve something much better than the classic kind of hybrid income approach. So that's a big positive there. And especially, this is good news for retirees who, with the eventual exit of bank hybrids, are going to be looking for alternative sources of income. So I think this is certainly one of them. Now, the next point I'm going to talk about is around retirement, about retirement stability, is around how we go about handling market downturns. And here I think machine learning and AI can play a really big part. For the last couple of years, my team and I have been really building out our quantitative toolkits to make sure that we can really sharpen our research capabilities and uncover little insights that normally you wouldn't be able to access. On screen is a sample of everything we use. I won't have time to kind of go through all of them, but I would like to just share with you one of these methods to give you a taste of how we apply, let's say, AI in bond markets. And so the quick example I can give you is, following every central bank meeting, there is a release of minutes, statements, transcripts, and each one of these documents contain some information, some clues as to what central banks are thinking about inflation, about growth, unemployment, whatever it is. And the thing is, rather than rely solely on human judgment, we instead apply an AI kind of technique called natural language processing, which allows systematic quantification of how hawkish or dovish a statement is. And once we've been able to do that, once we've gone through all the documents, we collate all these scores into what we call basically hawkishness scores and compare it against interest rates to see if we can pick out a pattern. And the interesting thing is, we've noticed over time that these hawkishness scores have a remarkable ability in predicting the next big turn in the yield market. So here's what that looks like in practice. The dark blue line is our US Fed hawkishness score. The yellow line is US 2-year Treasury yields. And as you can see, the blue line typically leads the yellow line by around 7 to 8 weeks, which is quite remarkable. It's very impressive stuff. But the real value isn't that this analysis can pick major turning points. The real power of this is the fact that it could do so in an environment where central banks themselves have lost all credibility around their models and their forecasts, right? And this is really important because when central banks don't know what they're doing, the rest of the market really doesn't really know what they're doing either. So there's a bit of confusion there. But by applying AI, we're able to kind of contextualize a lot of the recent decisions in the recent cycle, and help uncover some of the blind spots in this period of uncertainty. So again, this is really the real power of how we use AI, because again, it shows and uncovers blind spots where a traditional fixed income process or a traditional process in general won't be able to uncover. And so for us, we like to incorporate a lot of this within our portfolios and help build that level of robustness, build that level of sturdiness to kind of help our clients' portfolios weather whatever storm that may come. So yeah, look, those are the key insights I wanted to share. Hopefully they've been helpful. Ultimately, what I'm trying to do is basically ask the question, are we still being tethered to a very outdated playbook for retirement stability and retirement income? I think in some instances we are, and as such, I feel like there is scope or room in people's portfolios for a rethink on how to adapt for changing conditions ahead. So I'll leave it there. Thank you for your time, and I'll hand back to Vaughan.
Oliver, and thank you, Julian. Julian, I was just going to ask one sort of follow-up question. So just with the capital protection with SMAs, how would that, advisors explain those two structures together and how they would work together?
Well, capital protection, we often find that the clients that are using capital protection and advisors are using capital protection, they're not putting all of their portfolio into a capital protection product. They might might be using a bucketing strategy where they've got three buckets, and they could be using a capital protection product for that defensive bucket, which in doing so, the capital protection products act in a way like cash, in that there's no downside protection, but allows the advisor and the client to take a little bit more risk than they would previously take maybe in that defensive bucket. And then for the growth bucket, advisors might be using an SMA or a managed account. So that's how they kind of interplay together.
Thank you. Oliver, I was pretty much going to ask about the same question. So how would you build this into a client portfolio and sort of explain this to clients?
Yeah, excuse me. So the fund in question is, again, the Monthly Income Plus Fund. It's basically an absolute return income fund that we've tailored specifically to kind of solve for all the challenges around the SMILE framework, right? All these retirement risks that we want to solve for. And the genesis of it really is, years ago, we went to pretty much every retiree and said, what do you want? And they said, I want steady regular income, I want daily liquidity, I want growth, and most importantly, I don't want to lose any money. And so we've kind of tailored that strategy specifically for them in a lot of ways, right? And I think it's been really successful over time because, we've been running the fund for over 15 years. It's produced over 180 consecutive months of consecutive income, right, with franking credits on top. It's generated 2.5% above cash in terms of alpha over inception, and it's only suffered 1 year of negative returns since that time frame, so over 1 year and 15 years. So it's had a lot of successes, and because of those successes, we had the fund grow from about 15 million in 2009 to now 700 and 800 million today. So we're pretty happy with that. Now, in terms of how clients would use us, they typically go through one of three ways. The first way is they either apply a bucketing strategy, so they would put our fund into a liquidity camp and then draw down as they need, and then they would allocate the rest to Aussie equities, global equities, or whatever high growth strategy that is. The second way they use us is to put us in the fixed income sleeve. So as I've shown earlier, we're pretty good at picking out interest rate cycles, so it allows us to kind of capture all that alpha without suffering any of the downside. So they put us there because we're just better at the duration decisions. So utilise in that sense. And the final area is they put us in an alternatives bucket. So because of our low correlation to traditional bonds or equities, they see us a natural fit there. So that's kind of how we go about talking to clients about this, how they use us. So those are just kind of the three flavours we're kind of experienced too.
All right. Thank you. Is there any questions out in the audience? Sorry, just a sec.
Questions from the floor? We heard in the first session a bit of discussion about the utilisation of less liquid options within portfolios. I wonder if, and Oliver, you just talked about clients who said, I want daily liquidity. But for somebody who's got a 30-year perspective or 25-year perspective, How important is daily liquidity in retirement portfolios?
I mean, it varies from client to client, right? I've had certain clients who need it on the regular. They need a fund for holidays. They need to pay for their kids' mortgage down payments. They need to buy a second car, third car, God knows whatever it is. So in that sense, liquidity is extremely important to that client. But for those clients who have a particularly long time horizon, 20, 30 years, then absolutely maybe liquidity isn't a necessary factor. And as a result, you can go into particularly illiquid and high yielding assets like private credit, right? You can lock that up. That's perfectly fine. All I'm saying is for those clients who do care about it, who do want access to to fund shortfalls, or access to emergency funding, it is an important characteristic. And we have a number of clients who absolutely come to us and say, look, we need daily liquidity. We just cannot afford to be locked away. And I suppose the biggest example of this was pretty much back in GFC when all the mortgage funds kind of froze up, right? I mean, this fund, our monthly income plus fund, was really an answer to that particular scenario, because when people couldn't access their money, they got particularly agitated, they got particularly upset. And so we built this product just to kind of cater for that particular segment who wanted that stability, wanted that liquidity. But I understand that there are whole segments out there who might not be as sensitive to that particular risk.
Other questions?
All right.
Hang on.
Oh, sorry.
Hi, thanks. Just interested in your view about using like annuity type of products as part of the portfolio construction, given its potential use to either boost social security benefits or providing longevity protection.
I was going to say Julian's probably the annuity expert here.
I'll expire all of my annuity knowledge in about 30 seconds, and I'll hand over to Oliver. Yeah, it's interesting. I mean, advisors have had two key tools in their kit bag over the last kind of 30 years. You've had account-based pensions, and you've had annuities. What we're starting to see now, though, is a hybrid version, which is the new innovative retirement income solutions that provide, I think, a degree of flexibility that annuities don't provide, in the sense that you can you have full investment choice. So I think some of those new solutions that are hitting the market are interesting. It means that you can combine, innovative retirement or an IRIS and a managed account together. You're not locked into a particular investment solution. I think that gives advisors a little more flexibility around how they design portfolios for clients. But they do operate in a similar fashion, in the sense that they do give you the asset test discount. And they do deliver income for life. So worth checking out, I think, some of the new IRIS products that are hitting the market.
Yeah, look, I'm not an annuity expert by any means. I think Julian here is the go-to guy here. But look, I can only offer my insights from more of an investment perspective. And all I can say is, with annuities, there's always a natural trade-off. The more bells and whistles that you want, the lower the yield that you're going to get. So if you want inflation protection, you're going to a little bit less. If you want, to last as long as you want, then again, a little bit less. Everything you add on is going to eat into that income returns. And the thing is, and goodness, I hope I don't say something inappropriate here. The thing is, the way people construct annuities, like Challenge, the way they construct annuities is obviously to take your money, bundle into a bucket of assets, and then spit out the rest to give to you, and they keep the margin. So if you can kind of replicate what they do, then you could probably generate a better outcome for yourself. But obviously, they're offering that peace of mind, that insurance, right? But for us personally, we're able to kind of replicate what the challenge of the world are able to do. So we don't need to give you just, I suppose, a series of stable income. We can give you something similar with a little bit of tiny vol, but also a lot more upside. So that's...
All right, I think we're at about time. So thank you, everyone, for coming along, and enjoy the rest of the conference.